Good afternoon, realtors, clients, loan officers. Talking to my friends, referral partners, clients, and other loan officers here in Southern California, specifically Los Angeles County, to explain taxes, impound accounts, and supplemental taxes. So let's back up a little bit just to your basic tax rate. There's a lot of different things that go into creating the county assessment for the tax rate on property, but more or less properties in Los Angeles County are going to be taxed at about 1.25% of the purchase price. So if you take a purchase price of $1 million, you multiply by 1.25%, $12,500 a year for taxes. That'll be broken down into 12 monthly payments if you have an impound account, and it'll be a little over $1,000 a month added to the mortgage payment, about $510 a month added to the mortgage payment if you're doing a $500,000 house. Now, a couple things to keep in mind. The County of Los Angeles taxes are due in October. They're actually due October 15th, not late until November 15th. And then the next installment is due in March, due March 15th, not late until April 15th. So what I tell most clients is go ahead and impound your taxes, because those two tax bills come at the worst possible time, right before the holiday season and right before taxes are due on April 15th if you haven't paid your full taxes out of your W-2, or if you're self-employed and you owe self-employed taxes. So either way, I encourage all of our clients to take that 1.25%, roll it into their mortgage and payment, and have an impound account where the lender is collecting 1/12 of the annual taxes every month. They create what's called an impound account. There's a couple months of reserve sitting there at any given time, and then the lender will make those payments for the client on their behalf. Now, there's something I talk to with almost every client who buys a house, and I even tell them, hey, you're going to forget this when the nasty bill called supplemental taxes for the County of Los Angeles shows up. And here's what supplemental taxes are. Because very few people close escrow right on October 15th or March 15th when the taxes are due, the supplemental tax bill is the spread between the tax basis of the old homeowner and the tax basis of the new homeowner for the amount of time in which the new homeowner lived in the house before the first installment of taxes were due after ownership. So follow this example. Let's say my parents in Los Angeles bought their house for $300,000 20 years ago. They resell their house in 2016 for $800,000, okay? And let's say they closed escrow in the month of July. My parents' house tax basis was $300,000. The new owner's tax basis is $800,000. That's what the new tax bill will be assessed on. So what we have is we have a $500,000 spread in value that the tax rate was effectively incorrect or not updated from July, in my example, when the new owners took possession, till October 15th. Again, those taxes are late, November 15th. But from my July example to the first tax statement that goes out October 15th, there's a 4-month spread there of the old tax basis versus the new tax basis. And somewhere in the first year of ownership, the county is going to balance their books and say, oh, wait a minute, there was several months where we weren't charging the correct assessment to the new owners. They send out a supplemental tax bill. For properties priced in Los Angeles County under $1 million, it's usually somewhere between $1,200 and $3,500 for that supplemental tax bill. They do give you the option to pay it in 2 different installments, or you can pay it all at once. But most homeowners, no matter how much I try to remind them, escrow puts a piece of paper in the closing package explaining this, they always forget that the supplemental tax bill is coming and is due in your first year of ownership. So if you're a client, keep this in mind. If you're a realtor, this is something you should be talking to your clients about so that they're not upset 4, 5, 8 months into home ownership that they get this couple $1,000 bill. And I'm also going to post a link below to the LA County's assessor's office where you can run what the estimated supplemental taxes will be. It'll ask you for the address. Just put in the property address and the first name of the street if it has multiple names in the street, and then also put in the transfer date of when the property was sold, and the LA County Assessor will give you an estimate on what those supplemental taxes will be due. So important information. If you have any questions, post them below and I'll be happy to answer them in the comments. Talk to you soon. Bye.